Here's something nobody tells you before putting your first $1,000 in the stock market.
The market didn't lose it, the rules did.
58% of Americans are now investing, the highest number in recorded history.
And yet, the average beginner still loses money in year one. Not because stocks went down, but because of 3 mistakes that go completely untaught in schools, in banks, and in most YouTube videos.
Mistake 1, waiting for the perfect moment to invest.
Mistake 2, picking individual stocks before understanding how money actually compounds.
And mistake 3, the one that quietly wrecks more returns than any market crash, is letting emotions drive decisions in a game that rewards patience. Think about this. $1,000 invested at age 25, left alone, becomes approximately $45,000 by retirement.
The same $1,000 started at age 35 becomes only $17,000.
The only difference is information and time.
Today, we are stripping away the jargon.
This is the exact playbook for your first $1,000, the traps that drain returns before they even start.
And the one strategy that 79% of professional fund managers still can't beat.
Watch to the end. The most important part isn't what to buy.
It's what not to do first. To understand the stock market in 2026, we have to acknowledge a massive shift in how wealth is built.
According to the 2024 Schwab Modern Wealth Survey, nearly 3 in 5 Americans are now active participants in the market.
We are living through a democratization of finance.
But here is the paradox. While access to the market has never been easier, the behavior gap is wider than ever.
The biggest lie beginners are told is that you need to be an expert to start. You don't. In fact, being a pseudo-expert is often more dangerous than being a complete novice.
Many people in their 20s and 30s wait on the sidelines,
trying to time the market or waiting for a dip that may never come in the way they expect. Consider the cost of hesitation. Data from JP Morgan Asset Management shows that investors who stayed fully invested in the S&P 500 from 2003 to 2022 earned an average of 9.8% annually.
That sounds great, right?
But look at the penalty for trying to be clever. If you tried to time the market and missed just the 10 best trading days over those 20 years, your returns were nearly cut in half, dropping to just 5.6%. The stock market isn't a sprint. It's a game of endurance where the entry price matters far less than the time in the market. If you have $1,000 sitting in a savings account earning 0.1%, you aren't playing it safe. You are actively losing purchasing power to inflation. But before you click buy on that trending ticker symbol you saw on social media, you need to understand the math of the S&P 500. Since its inception, this index has delivered an average annual return of approximately 10%. On the surface, 10% sounds modest. It doesn't feel like the get-rich-quick stories we see online. However, 10% is the engine of the greatest wealth-building machine in human history. The problem is, most beginners think they can do better than 10% by picking the next Amazon. We've all heard the stories. A $1,000 investment in Amazon at its 1997 IPO would be worth over $7.7 million by mid-2025. That is a fact. But what they don't tell you is that for every Amazon, there are thousands of companies that went to zero. Even the professionals, the people with PhDs in mathematics and high-speed trading algorithms, can't seem to beat the simple average. According to the SPIVA U.S. Year-End 2025 Scorecard, a staggering 79% of actively managed large-cap U.S. equity funds underperformed the S&P 500. Read that again. Nearly 8 out of 10 people whose entire job is to beat the market fail to do so. If they can't beat the average, why do you think you can do it with your first $1,000?
If the professionals are failing to beat the market, we have to ask ourselves, why do we feel the urge to try?
It comes down to a fundamental misunderstanding of what your first $1,000 is actually for. Most people view their first $1,000 as a lottery ticket. They want to find that one penny stock or that one tech disruptor
that will turn their 4 figures into 6 overnight.
But in reality, your first $1,000 is not a gamble. It is the foundation of your financial house.
And you don't build a house on a foundation made of lottery tickets.
Let's look at the generation currently entering the workforce.
There is a fascinating trend happening. More than a quarter of Gen Z, about 27%, were actually taught about investing in school.
This is significantly higher than any previous generation, including millennials and Gen X. This means the younger crowd is coming in with more theory, but they are still facing the same psychological walls.
You might see your 401k balance, which for Americans aged 25 to 34 averages around $37,557, and feel like you're behind.
You might feel the pressure to catch up by taking massive risks. This is exactly where the industry makes its money, off your mistakes. This brings us to the rise of ETFs, or exchange-traded funds. By 2024, ETFs globally surpassed $10 trillion in assets under management.
Why? Because they solve the problem that 79% of fund managers couldn't. Instead of trying to find the needle in the haystack, an ETF allows you to buy the entire haystack.
When you put your first $1,000 into a low-cost S&P 500 ETF, you are instantly becoming a partial owner of the 500 largest, most successful companies in the United States.
You own a piece of Apple, a piece of Microsoft, a piece of Amazon, and 497 others.
You are no longer betting on a single CEO or a single product. You are betting on the American economy's ability to innovate and grow over the long term. But here is the boring truth that most influencers won't tell you. The reason ETFs are winning is because they are low cost.
In the world of investing, you get what you don't pay for.
Every percentage point you pay in management fees
Is a percentage point that isn't compounding for your future.
This accessibility and low-cost structure
Are exactly what driven the $10 trillion surge.
However, even with the perfect low-cost ETF,
Most people still fail to reach that 10% average return.
Why? Because of the behavior gap.
a study by Morningstar found that individual investors underperform the very funds they invest in by an average of 1.7% annually.
Think about how crazy that is.
The fund itself might return 10%, but the person holding the fund only gets 8.3%. How is that possible?
It's called emotional buying and selling.
It's the panic you feel when the news says the market is crashing, causing you to sell at the bottom. It's the FOMO you feel when your neighbor says they made a killing on a random stock, causing you to buy at the top. Your first $1,000 is a test of your temperament, not your intelligence.
The stock market is one of the only places where the more active you are, the less money you tend to make. For the American investor between 25 and 45, the biggest hurdle isn't the Wall Street sharks, it's the person staring back at you in the mirror.
If the biggest enemy to your wealth is your own emotion, how do you defend yourself?
The answer isn't a better stock tip or a more complex app. The answer is a strategy that only 36% of Americans actually utilize, a written financial plan.
According to the 2024 Schwab Modern Wealth Survey, nearly 2/3 of investors are flying blind.
They are investing by feel. When the market is green and everyone is celebrating on social media, they feel confident. When the market turns red and the headlines start using words like collapse and recession, that confidence evaporates. Without a written plan, you are a captain at sea without a compass, destined to be tossed around by the waves of market volatility.
Your first 1,000 needs a mission statement.
Is this money for a house down payment in 3 years, or is it for a retirement 30 years away? The answer to that question dictates everything.
If you are in that 25 to 45-year-old bracket, you have something more valuable than any high-frequency trading algorithm, a long-term horizon.
But a horizon is only useful if you stay the course.
This is where the behavior gap we mentioned earlier becomes a wealth killer.
That 1.7% annual loss due to emotional trading might not seem like much today.
But over a 30-year career, that gap can represent hundreds of thousands of dollars in lost gains. This is why set it and forget it is more than just a catchy phrase. It is a mathematical necessity for the average person.
This is why automated investing has become the gold standard. When you automate your contributions, you remove the choice to be emotional. You buy when the market is high, and more importantly, you buy when the market is low and stocks are on sale.
The stock market is perhaps the only market in the world where customers run out of the store when there is a 20% off sale. A written plan reminds you that a market dip isn't a disaster. For a buyer, it's an opportunity. But let's talk about the specific vehicles available to you. For many Americans, the first exposure to the market is the 401k. We saw that the average balance for those aged 25 to 34 is around $37,000. But many people treat their 401k like a black box they never look at.
They don't realize that within that account, they often have the choice to move away from expensive, actively managed funds and into those low-cost index funds we discussed.
If 79% of professionals are underperforming the S&P 500, check your retirement account. Are you paying a high fee for someone to underperform the market for you? If so, you are leaking money every single day. The goal for your first $1,000 isn't just to make money. It's to build a system where the money makes itself. By creating a written plan and choosing low-cost, diversified assets, you are essentially firing the expensive, underperforming experts and hiring the 500 most profitable companies in America to work for you instead. But there is one final piece of the puzzle. It's the difference between getting rich and staying rich. And it involves a concept that most people completely ignore until it's too late. The final secret to the stock market, the one that differentiates the wealthy from the middle class, is understanding that your first $1,000 is actually a seed, not a harvest. In our culture of instant gratification, we want to see the results immediately. We check our brokerage apps 3 times a day, hoping for a green arrow. But the stock market is like a tree. If you keep digging up the seed to see if it's growing, you'll eventually kill it. We've already discussed how $1,000 can grow over decades. But let's look at the compounding curves. In the beginning, compounding is boring. It feels like nothing is happening. If you earn 10% on your first $1,000, you've made $100. That's not life-changing. It's barely a nice dinner out. This is where most people quit. They think, this isn't working, or the market is rigged, and they pull their money out to spend it on something tangible. But look at what happens if you stay. By year 15, that same 10% isn't just on your original $1,000. It's on the interest, and the interest on the interest. This is the snowball effect that turned Amazon from a $6.70 IPO into a multi-million-dollar windfall for early investors who had the stomach to hold through the volatility. For the American investor aged 25 to 45, you are currently in the most critical phase of your financial life. Whether you have $37,000 in a 401k or you are just starting with your first 100, the physics of money are the same. Every dollar you invest today is a freedom fighter for your future self. So what is the what nobody tells you summary? First, the biggest risk isn't a market crash, it's being out of the market entirely. Second, you don't need to be a genius. You just need to be more disciplined than 79% of the professionals by sticking to low-cost index funds. Third, emotions are the hidden tax that will drain your returns by 1.7% or more if you don't have a written plan to keep you grounded. The stock market is a device for transferring money from the impatient to the patient. It is a system that rewards those who can look past the 24-hour news cycle and focus on the 20-year horizon. Your first $1,000 isn't going to make you a millionaire tomorrow. But the habits you build with that first $1,000, the habit of ignoring the noise, the habit of automated investing, and the habit of keeping costs low,
Those are the things that will.
If you're part of the 58% of Americans already in the game, check your fees and your plan.
If you are part of the 42% still on the sidelines, remember,
The best time to plant a tree was 20 years ago.
The second best time is today.
Stop looking for the perfect stock.
start building the perfect habit. The market isn't a mystery to be solved. It's a tool to be used. And now you have the playbook to use it better than the pros.